Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood, stock ticker HOOD. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For this conversation, we've pulled together analyst reports, technical projections, and some internal white papers, really trying to figure out if Robinhood's blistering run.
Yeah, nearly 300% year-to-date is definitely blistering.
Exactly. Is that built on solid ground, or is it maybe more speculative hype?
Okay, so where do we start? The fundamentals.
I think we have to. The sources right away show this company is, financially pretty strong right now. They're trailing 12-month revenue, a huge $3.57 billion.
Wow.
And net income is sitting at $1.79 billion. That gives you an EPS of $1.96 as of October 2025.
So definitely not just a startup anymore. This is a seriously profitable business.
That's right. And that income figure, nearly $1.8 billion, it's impressive. But you always have to ask, what's the quality there? Is it clean, repeatable operating profit?
Or is it boosted by one-offs? Yeah.
But the sources suggest this is actually operationally efficient growth. Their net margin is hovering right around 50%.
50%. How are they managing that in fintech?
Well, it seems to come down to two main things. Massive scale, obviously, and those proprietary revenue streams like payment for order flow, PFOF.
Right.
They process such huge volumes, transaction costs get minimized. Plus, they've successfully monetized things like options and crypto trading,
Which carry much higher margins than just plain stock trades, typically.
Exactly. And that margin, that efficiency, it really feeds into their competitive edge. They were the ones who, kind of cracked the code on making trading feel super smooth, mobile first, easy.
Yeah, that interface was a game changer. The traditional brokers, your Schwabs, your E-Trades, they spent years playing catch-up. That created the initial moat, didn't it?
It really did. It wasn't just about zero commission. It was about making it frictionless.
And we saw some major validation of that success recently, right back in September.
Huge validation. Getting included in the S&P 500 index, that wasn't just good PR.
No, it's structural.
It mandated buying. Every index fund tracking the S&P 500, they had to buy Hood shares. That provides this base level of demand and, of course, boosted investor sentiment immediately. It's like the ultimate institutional stamp of approval.
And they're not just resting on that, are they? What about innovation? Keeping that growth engine running?
Well, there's the recent partnership with Kalshi to launch prediction markets.
Ah, yes. The sports betting angle, essentially. NFL, college football.
Kind of. It's regulated event contracts, so you can bet on or hedge against future outcomes like game results.
Interesting. But is that like a major new revenue stream, or is it more about keeping users glued to the app? Because the big money still has to come from trading.
Yeah. Right. It's probably a bit of both, honestly. Right now, it feels more like an engagement boost. Gives people another reason to open the app, maybe make a trade later.
Makes sense.
But it does open up a potentially new high-margin revenue stream. And importantly, it diversifies them a bit more so they aren't just reliant on equity trading volumes. That helps differentiate them.
Okay, so strong foundation, efficient operations, big institutional validation. Sounds pretty good.
It does, but... and this is a big but, that foundation is maybe sitting on a bit of a precarious ledge when we look at the other side. The valuation.
Ah, yes. The elephant in the room. That sticker shock we mentioned.
It's definitely real. The forward price-to-earnings ratio, PE, is a hefty 65.43.
Okay, high, but maybe justifiable for a high-growth tech name.
Perhaps. But the one that really makes you pause is the price-to-sales ratio. PS, it's sitting at approximately 36 times.
36 times sales. Can you put that in context for me?
Sure. Think about a traditional established broker. They might trade at maybe 5 times sales, something like that.
Sure.
So when Robinhood trades at 36 times sales, the market is basically saying every dollar of Robinhood's current revenue is worth 7 times more than a dollar of revenue at a legacy firm. That implies absolutely stratospheric expectations for future growth, like accelerating growth.
So the takeaway for you, the listener, is pretty critical then. Robinhood has to deliver flawless execution, quarter after quarter of accelerating growth, just to justify the price it's at now.
Exactly. If growth even just plateaus or dips slightly, that 36x PS makes the stock incredibly vulnerable. We could see a sharp violent correction. They absolutely cannot just coast.
And that vulnerability gets magnified by the risks, right?
Definitely. First, competition. It's getting fiercer every day. Not just other fintechs, but those big legacy brokers. They've poured billions into their own digital platforms trying to win back retail customers.
They're catching up.
They are. And second, you just have to look at the stock's personality, its temperament. The sources flag the beta at 2.43.
Okay, remind us what beta means.
Sure, beta measures volatility relative to the market. The S&P 500 is 1.0. A beta of 2.43 suggests if the market moves 1%, Robinhood tends to move 2.43% in the same direction.
So much bigger swings.
Much bigger swings. It's extremely sensitive to broad market sentiment. If we hit a period where investors get nervous, a risk-off environment, you can expect HUD to fall much harder than your average stock.
And speaking of caution signals,
Yeah.
what about the insiders? What are they doing?
That's another interesting point, though maybe a bit mixed. We saw key executives sell off roughly $9.8 million worth of shares back in October.
Is $9.8 million really a huge red flag? I mean, the market cap is massive. The stock's run up almost 300%. Could it just be standard executive profit-taking after something like the S&P inclusion?
It's a fair question, and context is key. Executives often have preset selling plans, right? So it's not necessarily someone hitting the panic button. However, think about the timing. The big institutional story is overwhelmingly positive you just got into the S&P 500. And yet, the people who know the company best are still taking some profits. It just adds a necessary note of caution.
Yeah, it kind of reminds you that the price is high, and even some insiders seem to agree by taking some money off the table.
Precisely. Okay, so let's pivot a bit. Away from the structural stuff towards the immediate future. If you're thinking about buying now, you're really betting on some near-term catalysts coming up in the next, say, 3 months.
Okay, what are those key events?
The biggest, most immediate one is the Q3 earnings release. That's scheduled for November 5th, 2025.
Just around the corner.
Exactly. Analysts are already expecting strong year-over-year growth. But like we said, with that 36 XPS multiple, just meeting expectations probably won't cut it.
They need a beat. A big beat, maybe, and positive guidance. Some fireworks.
That's likely what the market wants to see to trigger new momentum and push past recent highs.
Okay, what else?
Don't forget the ongoing effect of the S&P 500 inclusion. Those indexation flows, the ETF rebalancing, that's mandatory buying.
Right. It's not optional for those funds.
Nope. There's a major ETF rebalance set for November 12th. Those kinds of scheduled purchases will continue to provide some near-term buying pressure, kind of a floor, regardless of the day-to-day noise.
And that Calci partnership we mentioned.
Yeah, we should revisit that. Even if it's mainly an engagement tool for now, its performance will definitely feature in the Q3 results or maybe the Q4 guidance.
So if they can show it's actually keeping users around longer or maybe helping them make more money per user,
then it could absolutely give the stock a short-term boost. It shows innovation is translating into results.
Okay, those are the near-term things. What about further out? The bigger picture, more speculative stuff. Where's the massive upside potential?
Well, this is where we move a bit more into the realm of, let's say, speculation, but it's definitely out there. The sources hint at 2 major long-term drivers that could really change the whole equation for Robinhood's market size.
Ooh, okay. Like what?
Yeah. The buzz seems to be focusing quite a bit on the official U.S. launch of the Robinhood chain. That's their own proprietary blockchain.
So not just using existing crypto infrastructure, but building their own.
Exactly. It's not just a tech upgrade. It's a play for like full control over their digital asset systems. Could mean faster transactions, lower costs. If they nail that, it really cements their position in crypto.
Okay, that's significant. What's the second one?
This is maybe the biggest one, the one that could really start to justify that huge valuation, potential major international expansion.
Going global.
Yeah, particularly targeting high-growth areas, think Asia, maybe Latin America. There are rumors swirling about Q1 for some moves there.
Now that would change the story.
Completely. If they successfully roll out globally, suddenly that 36 XPS doesn't look quite as crazy because your total addressable market just explodes. You're not just talking about U.S. fintech dominance anymore.
You're talking about potentially becoming a global financial utility for a whole new generation of investors worldwide.
That seems to be the long-term bull case dream, yeah.
Okay, let's bring it back to the chart. What's the technical picture telling us? Price action, key levels for traders.
Well, technically, the picture is overwhelmingly bullish right now. The stock's in a clear multi-month uptrend. That 288% year-to-date rise tells you that.
Hard to argue with that momentum.
And crucially, it's trading comfortably above both its 50-day and 200-day moving averages. That confirms the underlying strength is solid, technically speaking.
So for someone looking to trade this maybe, where are the key lines in the sand?
Right now, technicians are watching support pretty closely between $137 and $142. If the stock pulls back to that zone, it's seen as a potential strong buy area.
Okay, that's the floor. What about the ceiling? Resistance.
The immediate resistance level looks to be between $150 and $155. A clean, sustained break above $155, which honestly probably needs that fantastic earnings report on November 5th.
Yeah, needs a catalyst.
Right. That would signal the start of potentially a new leg higher in this rally.
And what are the analysts saying? Does Wall Street agree with the chart?
Pretty much, yeah. The overall consensus across, I think it's 21 firms, is currently a buy. That confirms the broad market optimism. We saw firms like KeyBank, for example, recently raise their price target to $155.
Which lines up exactly with that resistance level you just mentioned. Interesting.
It does. So, okay, we've got this mix, right? Incredible growth, validation from the S&P, operational strength, but then this extreme valuation, high volatility, intense competition. How do we synthesize all that? What's the final investment thesis for you listening?
Yeah, boiling it all down.
The overall rating, based on synthesizing these sources, comes out as bullish. We'd score it maybe an 8.5 out of 10. There's undeniable strength and momentum. But the decision for you really depends entirely on your investment horizon.
Short-term versus long-term.
Exactly. If you're a short-term investor, maybe a swing trader, this looks pretty attractive. You've got those clear catalysts coming up, earnings, index flows, product news. You can trade around those levels we mentioned, the $137 support, the $155 resistance.
Makes sense for active traders.
But if you're a long-term investor, you absolutely must be a growth investor focused on that big picture, the structural transformation of finance.
And you have to really believe in management's execution.
Completely. You have to believe they can execute perfectly on those more speculative big catalysts, the global expansion, the Robinhood chain, to keep that revenue accelerating and eventually grow into that 36 times sales multiple.
So definitely not a stock you just buy and forget about.
No way. This requires high conviction, and you need to actively monitor how those big speculative drivers are playing out.
Okay, so we've covered a lot. The huge 50% net margin, the S&P 500 validation, but also the kind of terrifying 2.43 beta and that 36x PS valuation. Fundamentals look strong, but the market has priced in, well, perfection.
That sums it up well. So maybe the final thought for you to chew on is this. Given that high volatility and how much the stock depends on really aggressive growth, potentially expanding globally, how much weight should you actually put on management pulling off those big speculative bets perfectly? You know, the global markets, the Robinhood chain launch. Is that enough to truly justify that massive PS multiple? That's really the core question you need to keep asking yourself as the story unfolds.